This is going to transform the self-storage industry. These third, fourth, and fifth tier markets, baby boomers, mom and pop, they're selling. This is going to pick up speed. So this is a really good time. You can buy great deals at great prices, and the market is now going to be in your favor instead of against you. Welcome everybody to Self-Storage Income. And today we have our forecast episode. Now, this one is going to look a lot, not at the larger trends, but how 2025 is going to perform within those larger trends. So it has been a major shift, and 2025 is a big transitionary time. So we at our firm, we have seen big changes in deals, capital flow, performance, all sorts of stuff. So when looking at 2025, how we're allocating our resources, ramping up, what kind of deals we're buying, everything else is predicated on this data, these assumptions, and that's what we're sharing with you today. So how the self-storage industry will perform in 2025.
Exactly right. No, I'm excited to dive into it and really not only paint the picture, but also allow people to see, a lot of the things that we're looking at. We're not looking at crystal balls. We're not guessing. We're looking at indicators. We're looking at past experiences, drawing from that experience, sharing that with you guys. So if you're going out there, you're buying, you're building, you're not stepping into a landmine that you have no idea that you're walking into, because like we've seen in just years previous, you had a lot of people going out and building, acquiring, trying to do things that didn't make any sense, thinking that occupancies would stay 90+% and revenues would just keep getting jacked up, right? And so a lot of those people, like we've mentioned in prior podcasts, are gone. How do you avoid those pitfalls?
Yes.
I'm really excited to really just jump in and give people a little bit of a roadmap to say, hey, here's where we think things are going to go, plan accordingly.
It's been a rough 3 years, for real estate, period, as everybody knows. And self-storage was unique in its ties to the housing market. And it has been a rough 3 years. And as we've been doing this podcast, because we've been doing this for a long time now, it's been growing and our audience has been growing, which is crazy. We were looking just even in the fall back in 50,000 listeners during, I think it was in October when we had it listened, and we're really grateful for everybody that listens to this. It's incredible. It's awesome. It was, when we started it was to be transparent and to give information out. And I realized we have lots of new listeners and new listeners that change. So before we get started, I just kind of want to say who we are, because I've had people reaching out saying, hey, we haven't done that in I don't even know how long. We're just on here talking our information. So
everybody should just know.
Yeah, we just know. So Connor and I, we work at a firm that I started called Cedar Creek Capital. Been in the self-storage industry since before 2008. And we have seen this industry change a lot from when we were in it, an obscure industry that was frankly looked down upon, to its extreme performance in recessions and lockdowns and all sorts of stuff. We've seen development cycles, and we have built, converted. Our specialty is buying and turning around storage facilities, but we have converted office buildings, bankrupt super Kmarts, retail centers. We build ground up. We have since 2016, and we've participated in all the aspects. So we are fully integrated in a real form. In fact, it is different. We call it universally integrated because we touch on all aspects of the business. We were founding members of the largest co-op for self-storage in the world, and we've been participating in the industry on also the technology side for a long time, including the largest investors in the company that is now represented by Store Local as well, Tenant Inc. as a property management system. So we focus a lot on data, operational efficiencies, and we believe and treat this like a business. That was what we predicated. I wrote 2 books on the industry, and that's what the books were based on. Turning a real estate asset into a thriving business, because we believe it is. And that played out to be true. So we're talking, 20 years doing this. And we don't have the longest, obviously, experience. There's other people that started in the 70s, 80s, and we've had a lot of those people on as these guests. But we're unique because we have everything internalized from our data, software. We own other software companies. We do our own sales in-house, from customer sales. We do the syndication, raising capital. We do the financing. I mean, all of it. Development, architecture. Yes. On and on and on and on. So that gives us we're in 10 states, over 3 million square feet. And that's not including our partnerships and working with others. And we have the largest educational platform in the space. So what we get to see, I think, is unique. Just how we came about it. Because a lot of people, they play one aspect in the industry, right? It's just, we are a syndicator. There's not very many people that they go outside, including into technology and software and everything. And that's exceedingly rare. In fact, I can't think of another firm on the top of my head that goes so deep. And the reason being is, when we started the firm, it was under that thesis, it's a business not. So we actually allocated huge amounts of capital into the business of self-storage, not even the assets. Literally millions we would pour into it. So with that, we're trying to represent it from all of these sides, what we see in development, what we see in the economics of it, what we see in the operating in it, the day-to-day. Now, Connor heads up our management company. So the actual operations, the actual doing these things. We're not talking about, oh, we see this industry from afar. No, it's every day. We're in here. We got our sales team in here, right? Getting new people in the door, all the issues, the problems, facility burning down to everything, guys. We are in it day to day.
Yep.
I just wanted to preface that before we start. Now, with that said, 2025 is going to be a very interesting and transitional year, as I think 2024 was. But 2024 was, as I'd stated, it would be the bottom. This still tracks everything that I put out in 2021 when everybody was doing awesome, everything else, and I wrote the self-storage bubble, which I said, self-storage is in a bubble. This bubble will pop. We'll see higher interest rates. Occupancies and rates will plummet. And I outlined, before interest rates, all that had gone up, what was going to happen. We're still right now in line with our 2021 guide and estimate to what would happen, how the bubble would come up. And we're still tracking. That's still following. The details and how it is a lot clearer. But during that time, back in 21, we believed that 22 would be the start, 23 would be bad, 24 would be bad, but we'd find the bottom. And then 25 would be the change into the new cycle. So that's a top level overview. We still hold to that. We've been talking to you guys about this, but how that actually plays out, the numbers, what we're seeing and regionally, that stuff is wildly different. So it's not like you can just go, oh, okay, that's a guideline put up. No, that's not true. And we're going to get into a lot of that today. The application of that cycle, investing and operating within it at this point, and what we've seen as we go through it. Technology is the name of the game, and how you operate your facility and the efficiency at which you can operate will depend on the technology you use. Your property management system, what it allows you to do, and what you have access will determine the outcome of how that facility performs. That's why we go with Tenant Inc. with their product Hummingbird, because they are the best in class when dealing with automation, when dealing with move-ins, customer acquisition process, improving my online acquisition process. They are bar none the best. So if you are looking to automate your facility or operate it in a best-in-class way, make sure you guys are looking at Tenant Inc. and their product Hummingbird. The link is in the description.
I'm excited to dive into it as well. I want to recap a little bit and let people know a lot of these things that we're looking at are macroeconomic elements that we're looking at and indicators. That doesn't mean that it's going to apply to every single market all over the place, any of that.
For this episode.
Hyperlocal.
Yeah. For this episode, we're talking about that.
Yep.
Most episodes we're in here and we're talking about marketing, right? Connor, we're talking about, oh, we did this trick, or we're interviewing somebody, right?
Exactly.
This is the overview for 25.
Yes.
Thank you, Connor. That's a really good point.
So keep in mind, We're not talking your specific facility you're looking at.
No.
This is everything across the board. Yours could be a heck of a lot better or a heck of a lot worse in whatever aspect.
And that's actually an indicator of this point in the cycle we're in.
Yeah.
Because
that's very true.
Yeah. If you went back to 2018 to 2022, even before that, probably 2017, there was really very little separation amongst markets.
Yeah, I was going to say when values were really aligning just across the board.
Occupancy, everything. It all just went up. And that was not normal. And so 2018, 2019 got really heated. And then it was just 2019, 2020, 2021, right? It was just everybody lifted rates. Everybody was occupied. Mm-hmm. That was not natural. And we talked about this for a time. Like, this is not normal, everybody. It shouldn't operate like this. We had 3 years at 96% on average occupancy, where prior to that, for the history of the industry, we had like 1 year maybe that we even hit 90% as an occupancy. 1 year. The rest of the time, it's always been 86%. And it was wildly different, predicated on the market that you were in. That also happens to be when the vast majority of syndicators and funds and everything else got into the business. And so there's been a whipsaw. And a lot of people started to make claims like, oh, the self-storage industry is done. It's over. It's not doing good, or it won't come back. I mean, no, it was returning to normal. Now, that normal, though, is going to be very dependent on where you're at. Mm-hmm. Some people's normal was, we never dropped below 95%. Other people's normal was an occupancy. Oh, geez, we got down to 60,
Yeah.
So it was just wildly different. But overall, it was a big contraction. It was the largest contraction in rates that we have ever seen. And we've talked about that in other podcasts, and we will hit briefly on some things that are changing. Those were all new, though, and those weren't really foreseen. I did not anywhere close understand or could foresee. We knew rates would go down and everything, but the extent of which, why, it was dramatic. You saw street rates that were dropping 20+%. Mm-hmm. We didn't see that in the Great Recession, right? That didn't mean that rates of storage facility, though, were dropping. That added to huge confusion. A lot of people were like, oh, these are all going out of business. No, it's the lowest defaulting asset class of any commercial asset class. And there's reasons for it. But that didn't mean that there wasn't pain and that the street rates did drop. So those that were looking from the outside got very confused, not knowing there's three different rates, a promotional rate, a street rate, and an in-place rate. Your in-place rates could have gone up 6%, and your street and your promotional rates could have dropped by 25%, and then your street rates could have been down 10%. That's not normal. Like, it's not like you go to an apartment building and they give you a promotional rate of 25% off the rate. That's just not a normal functioning thing, where it is in storage.
Yeah. Well, and something that was interesting about that as well is because what drove a lot of that too, and especially the markets that we're in where we're competing with REITs and so on and so forth, is they have the ability to drive those rates in that way to help drive and maintain the occupancies. Whereas REITs haven't really expanded into those markets within, well, they've only expanded into those markets within the last 5-10 years.
Yes.
Even when I started with you guys, I mean, it's probably about 6 years ago now. It's crazy to think, but we didn't have REITs here in our area, in the Boise area at all.
Yeah. In our city area of 900,000 people or whatever it is, we didn't have any REITs.
And how like that back to normal, even after those big swings in the cycle, like our return to normal was not only a return to normal, but also kind of a change in what competition looked like and how we had to run assets and manage them. Like it's just amazing.
Completely different normal as far as operations go. And that is the big thing that changed, honestly.
Yeah.
When we say it's a business, right? And the things that we were doing to prepare everything else, that became not an advantage after the contraction, interest rates went up. That became a necessity. Mm-hmm. And that was the big change. Yeah. Our competitive advantage became a necessity. In fact, our competitive advantage had to go a whole layer deeper, which we have been doing and rolling out, which is a totally different layer. Mm-hmm. But that is a big change for an industry that was treated basically like real estate. So all of a sudden, you have areas that are more hyper-competitive because REITs have entered into them now, and that was changing things, and that made things operate differently as a survival mechanism. But they were doing this at a time, and nobody noticed a difference. Why? Because there was no occupancy. Mm-hmm. So you don't notice competition when there's no available space. So what a REIT moves in and they open up a big new development when it doesn't even affect really your occupancy. Why? Because there's so much excess demand that was artificial during those times. And you didn't really notice it. You didn't have to be better. You didn't have to be a better operator.
Exactly.
It didn't matter, even though competition was coming in. So what happened was after you had an expanse, operators like ourselves, REITs, others that focused way more, they expanded into all these markets and were going from first tier to second tier markets, right? Then no, it wasn't necessarily, didn't change a lot of operators' need to compete until interest rates went up, the housing market stagnated, people stopped moving, that created vacancy, and then you're operating, it mattered. It made the difference of everything. Well, once that vacancy came up, you also then had the next factor that we had learned during the Great Recession was that people that are renting a unit, once they're in, the economics of that person, their sensitivity towards pricing is radically different than trying to get a person to move in. And so the REITs found that they could up in-place rates dramatically and people wouldn't leave. So that meant they could discount to get them in and still get to a rate they wanted with that individual. That's very unique to storage. And what that meant was price wars started because it was just fill up, get as many people as you can. And the price to get them in at mattered very little. We had markets that a 10 by 10 rate was $200 and it dropped to $80 because one of the big storage companies came in and had a huge facility and they dropped that street rate to $80, right? We'd never seen those things in storage. You didn't see a rate that was cut by 60%.
It was unreal.
Right? It was unreal. And so that changed that landscape. And that landscape was driven by operational changes and technology. And that's why a lot of our companies that we've started and work with, like Store Local and Tenant, became so important because it was to give those people the tools of the REITs. But 2022 is when we saw that change. That's where interest rates went up and that's where the demand fell. We went into a slow season. So storage has slow seasons and busy seasons. The slow season came, lack of demand. The busy season came in 2023. It just didn't exist.
Yeah, it didn't happen, man.
Right, didn't happen.
We were sitting there driving everything, pushing super hard. And occupancies were just creeping around. And some facilities stayed stagnant. It was just unreal to see. So I'm excited to see. We were just talking earlier about how we've seen some really good numbers so far.
Yes.
Not only just tail end of 2024 and kind of throughout 2024, but what we're hoping to see here in 2025.
Yep. Now let's look by the numbers. So what I've done is I've tried to take out some numbers here that we can take a look at to see some of these trends that have happened in the industry. What we believed would be the stabilizing point in 2024 what that meant was when the busy season came, we actually filled up in 2024. It didn't mean we were really full. It didn't mean that we were getting super high rates, anything else, but they did come back. We did fill up. We could stabilize occupancy and we could start normal rate increases, things like that. That had been gone, right? And so that stabilized. Doesn't mean you're doing great and huge growth, anything else like that. Even though we did, all our facilities grew in revenue, but once again, nothing like you'd predicted or thought that anybody had. So during 2024, the first half of 2024, one of the big things that had changed was we saw transaction volume change. The increase was less than 1% compared to the same period in 2023. That is a huge change. And transaction volume, we're talking about the buying of assets. So we have on the operations side, interest rates moved us into a new cycle because of the tenants. They're not moving as much, so not as much increase. The asset side, there's less buyers because the buyers and the sellers valuations are completely off because sellers were still trying to sell as if interest rates were 3%. So basically transactions just died. Yeah. We saw rental rates in units decline by 3% year over year. And that was for in place. Where we start to see a bigger change when you start to look at it is in the United States specifically, everybody we're talking about, there was a big buildup on development. And development, we had basically a 5% increase in 2024 compared to 2023. Now, there's a huge development cycle, and this takes a while to get through. We actually believe that 24 to 25 this year is peak development cycle. Everything shuts off. Why? Because if you start a development, well, it hits the market years later. So you start it in good times, you can't stop it. You're building, it doesn't matter. You've already got approvals, money's allocated, everything else. So they come rolling out. So it's a huge laggard, right? And that's exactly what we've seen. So in 2022, 23 to 24, at 22, 70 million square feet were delivered. 23, there was a 17% drop at 58. And then in 24, there was a 4.85% increase to 61 million square feet. So still less than 2022, but it was up and it was still a lot. And that change, though, and that drop, everything else, that was driven mostly by lack of demand, rates dropping, so underwriting changes and interest rates. If you hadn't been approved for your capital things, you're going to start to see that. But once again, that doesn't mean in 24, you're still going on underwriting and funds that were approved in that other time. That's why 25, we believe this is the peak, as in it's the tail end of all of it. Occupancy and demand, 2022, once again comparing, 93 to 96%. 23 dropped 6% to 90%. And then 24, we saw a stabilization there. Now, that is not what we saw, everyone, though, in rates during this time. So rates, we saw the larger shift. When we look at our overall rates, the street rates in 23, that's where we saw the most significant drops, but they actually didn't change. As in the promotional street rate that you offer a new tenant, they still dropped. And so areas with new supply had bigger, areas that didn't, but all of them, basically across the board, regionally, everything, promotional rates went really down. Now, in-place rates, right, that's a trickle effect too. Because if you're giving promotional rates and you're dropping your street rates, the people that were already in, you're still giving them rate increases. As those people cycle in over the year, the average in-place rate theoretically would come down, but you're offsetting it with giving rate increases. It creates a stagnation effect on those rates. So we saw marginal increase, like 3%, right? As far as rate go. Now, when we look at the reduction in supply, most people, including Yardi, others, as well as us, when we look at those peak deliveries, we believe that in 2025, we're under 50 million, but we believe it will be not dramatically, 45 to 50 million. So that is a substantial increase. It just is, right? With lower demand. And if you compare that to, let me go back to here, 23, 2, and 5, it's 70, roughly 60, 61. So it is a decrease, but it's still a substantial amount because you're going off of some peak times here.
Yeah, you're seeing more of that stabilized output, you know, coming from that 70 all the way down to 58. That's a big swing.
Big swing.
And then it kind of stabilized in 24. And again, we're expecting more of that stable output in 25.
Yes.
Yeah.
And that's when things change dramatically.
Right now, financing for real estate is really hard, even for self-storage. The markets are very challenging. Live Oak Bank is a specialist in financing for self-storage, including SBA loans. They are one of the leaders in financing all sorts of deals and deal size. We trust Live Oak Bank for their specialty in self-storage, their unique approach, and how they help their customers go through the process so there's no surprises. That in itself is a testament to their exceptional service and support. So whether you're looking to acquire, build, or expand a storage facility, Live Oak Bank has to be number one on your list to call. Click the link below right now so you can experience the difference that a dedicated self-storage partner can really make.
Based upon 26, 27, so as once again, this is why that 25, this is the pivotal shift in years. Because what happens is in this tell, we're tracking supply. Supply affects markets because Demand goes down, demand stabilized. Now we're looking at supply. We've stabilized occupancies, right? Rates have now kind of stabilized in 2024. Supply then will affect how much we can get because the lack of supply will then should theoretically over the years increase demand. That's why 25 is the shift in a year. What we see through there and what we have, Yardi has reported in supply projections in 26, 27, we expect a 2% growth of existing at 38 million square feet. That is expected to continue with a 38, almost 40% decrease in new supply out to 28. So I talk about the 3-year runs. 22 to 25 was that 3-year run. We're now on another 3-year run that is the opposite of the buildup. You can see now why this affects that supply and demand, okay?
I was going to say, imagine increasing your demand at your facility 40%.
Yeah.
Because
wild.
that supply decreased.
It's a big change.
It's huge.
Huge. So once again, you see why 24 was the bottom. We saw, and I talked back in 21, 22, this is where it's coming. It went down to 24. 25 is the first year that we're seeing now the new up cycle, and it'll build upon itself. This will largely be dependent on the housing market. So we have a shift in supply that is focusing on a new normal of demand where the housing market isn't, we don't have as many people trading out. They're not buying, they're not selling. The level of homes sold is below 2008. I think we're below anything in the 2000s. This is important because how much of our population increased during that time? Yet we're at lower transactions than we saw in the largest real estate housing recession ever. It's not that people are losing their homes. No, they're stagnant. Why? They're locked in at good rates. They don't need to sell, and buyers can't afford. Mm-hmm. So we anticipate more change in the way we utilize housing and space, people moving to more renters and more apartments being built, right? So units for people to live. So moving into a renter nation is like lots of people talk about it. The only way you can affect prices of homes really at this point is through supply. Mm-hmm. There's just no if, ands, or buts.
Yep.
Higher interest rates mean less supply for housing. Less demand for housing, mean units sold, means less supply because builders aren't going to build. Nobody's there to buy them. It costs too much to build. This is a problem that started after 2008. We are millions of houses short. Millions. Even at the highest interest rates that an entire generation's ever even seen, multiple generations have ever even seen, prices aren't dropping. And it's getting worse as we go. So we don't expect there to be this huge resurgence in the housing market where people are buying something. We think that it will rise. We will see more people buying as it goes. But until we get more units out, prices of homes will not just contract. In 2008, we were oversupplied and interest rates went up, right? We don't have that. With that said, housing prices, we believe, will go down, but it's not, I mean, we're talking regional specific, nothing nationwide, and it will not be dramatic. Okay, with that, where does that put us here now in overall 25? We're talking, we're in the peak. This is why this is so fascinating and so interesting, and why this is the 24 and 25 are the two most important years. 24, the bottom, 25, the start of a new cycle. And we had another video that we talked about this, but this video, we're talking about what that means for us in this year. 25, I do not believe we're going to see dramatic changes in overall demand. The reason being is we are still having new starts roll out, as in supply is still, even though not as much, it's still coming out. It is still more than demand is. That means regionally specific places will get hit disproportionately more. If you add on new supply and it's already weak demand and you're not having a resurgence in movers and everything else, you will see a bigger hit. What we'll also see now is the performance of operators has gotten very large.
You're talking the gap in operations.
Operations and what the outcome is for operating and what they can yield compared to another. This is once again focused on second and first tier markets. When you get into third and fourth tier markets, generally it's all the same. They operate like traditional real estate. There isn't a huge amount of changes in the supply and demand because people weren't developing there. You didn't have mass development cycles, right? Rates are still relatively the same, occupancy is the same. So some people may be listening, they're like, I haven't noticed much of a difference, right? Well, obviously, if there's no new supply and your type of competitor is not changing, so it's not being more competitive, you won't have, that's traditional real estate economics. Simple supply, demand, you have it. This creates a rate runway for these areas though. So I talk a lot about the rate runway. Where are rates going to go? You will see those areas will be disproportionately benefited. Why? Higher interest rates, even though demand's come down, they're going to be short new supply forever. Why? Building cost rose so dramatically through inflation. You can't go build and charge what you need to charge in a fourth tier market in most markets to make it make sense. It just doesn't economically make sense. The cost of building so high. Add into that 7% interest rates, nobody's building. So a lot of these markets, they're going to see high occupancy and they'll see the ability to raise rates, right? Because there's just supply lag.
Yeah.
Doesn't exist.
One-man show.
Yeah. And there's no real good competitors.
Exactly.
You can do little things to outperform. Right? Even first tier markets that are going to be totally safe and fine in general are the ones that these are REIT dominated because it's constricted by laws. You think Southern California, where you just can't put new supply out, right? Those areas always do well. That's why REITs buy it. You have the swing markets and the middle markets. These are the ones where you're going to get a very large performance separation because you have REITs, regional players, and mom and pops all together. They were growing second tier markets. So you have inventory also coming in the mix, and yet you have a reduction in people and supply. That's why swing markets are swing markets. These are the markets I play in. I know them intimately. We saw this in 2008. We've seen it through the other cycles. We moved out after I wrote the self-storage bubble, everything else. We actually moved out of the fast growing second tier markets. We moved into markets that weren't growing that fast, and we changed up our philosophy. We've now started to move back into those second tier markets. Why? We're on a new cycle. So we're actually putting out product developments, everything else in these markets that we're very excited about because a 40+% reduction in supply coming, right? That's huge. It's benefit. So we're very excited about this. And we did the same in 2008. Prior to 2008, we didn't buy anything in those markets. We focused on totally different markets. After 2008, we started buying in fast growing markets. The problem and issue that people have right now, if you're trying to get in and trying to buy, especially in those markets, the institutional level facilities, they can still command high prices. We sold one of our assets a month ago at a 4.5 cap. So interest rates are 7, and we sold it at a 4.5 cap. So people are willing to pay good products, good operators that can get margin out of it, that they can do things better. And so that makes it harder to find opportunity if you aren't a big shop. Where you find opportunity then is in the third and fourth tier markets, because the next thing that's happening is we're hitting like peak retirement by 2030. This is going to transform the self-storage industry. These third, fourth, and fifth tier markets, baby boomers, mom and pop, they're selling. And this is going to pick up speed. And as they do it, buyers are going to come in. You have the largest players that are REITs. They're not buying those facilities. They can't. It doesn't make sense for them to do it. If I am a $50 billion company, the transaction cost of buying a $500,000 facility, it doesn't, like, you'll never make money on it, right? It's a waste of everybody's time.
Yep.
There's huge opportunity in this. You have a good rate runway. You have transfer of assets from generational reasons, real sellers, not because they're going to yield a lot of money, but 2, those assets in those markets are affected way more by interest rates. As in, I can't pay you a 4 cap in this market if interest rates are 7%. Nobody can finance it. Banks won't finance it. Nobody buy it. So those sellers have no choice. When you are selling to an institution, though, their money isn't predicated on normal interest rates. They sell bonds. They have cash on hand. So if interest rates are 7 and they want it, they can buy it at 4.5, and it's totally different economics. Those small facilities and small markets, they don't have that. So we're buying facilities. We just sold one at 4.5. We're now in turn going and buying ones at like 8, right? That's a great spread for us to shift around our portfolio and assets. Trade out higher, buy in lower cost, higher upside valuation. We're doing a lot of that. And that is a lot of 2025 for us. We're taking chips off the table. We're reallocating capital. We're buying upside right now. And we're buying it at a price where 3 years ago, that one that it was an 8 cap, it was selling at a 4. That's a 50% difference, right? In price. Huge. Massive upside in these things.
You're talking millions. I mean, you're talking like some percentage points that it might sound like that. I mean, just hearing it, maybe if you are for the first time.
Yeah.
But you're talking millions or tens of millions in value on a few percentage points.
Because of the timing of interest rates in a year. That difference, I talk a lot about, everybody, intrinsic and extrinsic value. That's what we're playing on. It has good, solid intrinsic value, good renters, good operations, everything else. But the extrinsic value, meaning the buying and the selling of the asset, that's gotten killed because nothing to do with the asset, just markets. That's what I love to do and how we play the game. That's what we did after 2008. That's what we did prior. I love that I'm buying something that has really good fundamental intrinsic value, because things that don't have anything to do with it making money are affecting the price at which I can purchase. It goes on sale. And so we're buying and moving into a lot of those. We are very contrarian, I think you could say a lot, because we're developing and we want to develop more right now.
Now's the time.
Now's the time. Yeah. We're opening up huge facilities. We're bringing a market, opening up. We have one of our largest facilities that we're starting this year. It's massive. The whole development site, everything else.
Well, I mean, just go back to that point, and those Yardi statistics, 2028 leading up to that, you're talking about a 40% up to 40% potentially reduction in supply.
Why our population is growing.
Yeah, start now. Drop those things in the next 2 years. Your assets are hitting the market at peak demand.
Yep. This is a great, great play. I've told everybody this. I've said it multiple times. Right now is the best time to start, hands down. So many of our competitors, they're gone. So self-storage was this awesome, cool, new hot item, everything else. And then a bunch of articles came out, rates dropped, and everybody's like, oh, it's a terrible asset now. And I'm like, great.
Yeah, thanks.
Right?
Yeah.
More to us. So many of our competitors, fundraisers, things like that, they're gone. They just left. And so we have less competition. If you are starting out, that means you have less buyers. If you're going into a 4th or 5th tier market and there's a facility for sale, you may be the only buyer. 3 years ago, you had cash buyers. You had people that close in a week. Here, I'll give you a blank check. It was crazy.
Dude, it was insane. I remember literally
insane.
We went and walked in one of the properties here locally for sale. And I mean, we were talking to the broker, and we were looking around, and he's pretty much like, yeah, we've got somebody else that's ready, cash buyer, they're ready to close. Like, dude, it was like just a few days or something, like no due diligence, no nothing. Like just
check here.
Okay. Have a good day, man. Well,
it was wild. That is
crazy
horrible
times,
time.
dude.
Even though you're like, well, there's lots of money, everybody's doing good, rates and occupancy are going up, so I want to buy. At the same time, you're buying something that you can't change. Once you pay a price, it's paid.
Yeah.
So if that price changes 2 years later, it doesn't matter. It doesn't change for you.
Well, and again, too, you're buying in those times when the macroeconomic factors are impacting value and not the actual business asset itself. And that is not what you want.
Yep.
And that's the beautiful thing about storage is we can do these things like sell at a 4, buy at an 8, go into markets, treat it like a business.
Up occupancy, up rents.
Yeah.
So it's a double whammy.
Yeah.
And this is how we catapulted and made so much money, because that's what we were doing. We were buying, we were trying to time the overall market, but we were executing micro. As in, I say, I don't care what the market does. And we don't. We just buy when it's up, when it's down, when it's advantage.
Yeah.
All we're doing is looking at fundamentals, drivers. We're not predicting outcomes. That I don't do. That doesn't happen. And we don't buy because we think the market's going to do something in 3 years. We do not do that. We buy good fundamental value add assets, right, that have the drivers of demand and things in it. Meaning that over the next 3 years, yes, of course, you'll have markets where one person will build and it will destroy that market, or that are just not good buys, not good fundamentals. None of this ever. I would rather buy a incredible asset in an incredible market that has no new supply and really high demand, right, than get it at a decent price, but it has big upside, than a bad asset in a bad location, but a better price. I want to buy at a good price, a great asset in a great market with lots of demand. I want those two things together. We're always buying, we're always finding those deals, and you can find those in any market cycle. In 2025, you're going to find more good deals, but less total volume of deals. So this is important. If you went back to 22, the transaction volume was huge, but great deals, there weren't a lot of. Today, there's a lot of great deals, but there's really low transaction volume. We're buying off-market deals, seller finance deals. We're getting, we're talking yield rates on cost 10 in good markets. This didn't exist.
You couldn't buy anything that was achieving that. And I think you bring up a really good point where we've talked a lot about this potential upside and the supply and demand ebbs and flows. And now's the time to build, now's the time to buy, all those things. But even though we're talking about those things, a good deal is a good deal. Just like what you're talking about, we're not planning on a 40% increase in value because this is going to happen in 20, quote unquote, air quotes, going to happen. Like we are planning for today and we are using, just like you said, we're not timing markets.
Nope.
This is just the outlook, icing on the cake. If it happens, great. But that we're not banking on that at all.
Nope. It's today. We're buying good deals today. And we buy in good deals today that the market's good, everything else is good, so the outlook is good. I don't want to buy a good deal in a market that's going to go south, obviously, right? Yeah. That doesn't make sense. But we don't expect the market to make us, we expect the market to kill us. I've said that over and over again. I was saying that back in 21. I'd say that's in 2015, forever, right? And that stands true. 2025, this is really, really important. You just happen to be on now the side of the cycle where the market is going to help you instead of the market hurting you. That is very different. It's funner. That's a lot funner.
Yeah.
Fighting the market sucks.
Dude,
it's not something you want to do.
That whole rate battle thing.
Oh, it's really, really tough.
Yeah, that sucked.
It sucks bad. And two, also with that, companies had to change their operational procedures. What worked in other markets didn't work then. Everything from technology, all that. If you're now looking at coming in, you're coming in and that's all known. There's now products, literally technology products that we needed that we didn't have. We had to create from your property management software systems, from your marketing companies, on and on and on. So this is a really good time. You can buy great deals at great prices, and the market is now going to be in your favor instead of against you. So as people, and this is how it works, as people leave the market, it's actually when you should be going in. That will change, as in by the time everybody figures that out, then prices go up, cap rates go down, there's less good deals. So there's always unknown, there's always risk, right? That's why you focus solely on the deal at its present. Too many people, though, aren't wanting to buy even good deals because they're worried about the future. But they bought bad deals because they weren't worried about the future, and that killed them. That's the funny thing about this game. If you buy good deals and the future turns south on you, you're fine. If you buy good deals and the future goes up, you hit the lottery. But if you buy bad deals, the market can literally wipe you out. But the market can also reward you for buying a bad deal. And we saw this a lot. People bought bad deals and the market just got so good it didn't even matter. It created bad habits, it created bad products, it created bad capital. Everyone got hurt from it. Nobody survives these storms. the storage operators aren't better off. It's not easier. It's not better. Like even if they were a really, really good operator, right? We all suffer it. Just some of them will survive and then use that to actually catapult them to the next level. If you're starting out, this is the time you want to be in, even though it's the time that everybody's like, interest rates are high. Self-storage hasn't done good for years, or, hasn't done good. It's always grown. At default, good is relative, but it not like it was in the past when it's gangbusters. So why would you be doing that? Those are the reasons you should be.
Yeah.
And that's exactly what our firm is doing. We've changed operationally huge. I mean, the amount of work that you and the team have been putting in to our everything from how we do ads, rental rates. Wow, last 2 years.
Customer acquisition flow, all of it.
New sales team you got.
Oh yeah, no, it's just totally wild to think about where we were. And that's what really got me to thinking about like how these markets were that we're in when I first started versus now.
Holy cow.
It's like we were launching rockets in the backyard, but now we're at SpaceX, putting the rockets together and going to Mars. Like there's just totally different worlds, so much more science, so much more pieces, so much more analytics to everything.
How our firm has improved.
Oh my gosh.
It is wild.
Yeah.
This is hard to explain to somebody if you haven't started a business, if you haven't been in the game or anything else. You don't know what you suck at when markets are good because you can't see it. You literally can't see it. The market covers up all your mistakes. This happened with us. When you're at 96% occupied, and you just give rate increases and everything goes up,
we're good.
You don't have to market. You don't have to do anything. And then cap rates go down, and it's not even that you're ignoring it. It's not that you're thinking it doesn't matter. You just can't see it.
It's kind of like an allocation of resources too, where you're like, okay, well, if I'm going to look at this,
buying.
why would I focus on something that's not broken? Like,
and two, that maybe doesn't even exist.
Yes. Yeah.
Like
you just
the
don't
whole
know.
rate drop, 20% thing, that didn't exist. It didn't exist before. It never had. So you didn't have to build anything or change operations procedures or anything else to do it. Like this idea that you would discount a rate at that level and then have an aggressive rate increase schedule of 3 months of nobody totally knew, right? And now we see. So 2024, that's stabilizing in operations and performance. 25, we all know the game. It's not unknown. We're teaching you here on the podcast what we're doing. We've had, you go back and look at the podcasts on the rates. We had a whole episode where we showed rate increases, how it's done. We teach you guys all of that here. And that's the great thing though about now. We know, we saw what we did bad, what we were screwing up on. Couldn't even see before. Then we had to fix everything and build everything, to it. But the difference is we survived, we're fine, right? As opposed to people that bought bad deals, they don't. That was the same thing that happened to us through 2008. Everybody else went away. We were fine, right? The basics and the fundamentals and being good storage operators, that we did really good. And that allows you to make mistakes, even ones that you don't know. I refer this a lot as my margin of stupidity, meaning I have to be able to be stupid and successful or else this won't work. The problem is you could be stupid and just be rewarded time and time again and be really dumb and never even know it. And you were successful, right?
Yeah.
And so
it freaking happens, man.
Yeah. So you got rewarded for being stupid.
Yeah.
And so you didn't have a margin of stupidity at all because it didn't matter. You actually thought you were smart. And a lot of people did. Wow. It was amazing to me how many experts there were in these just phenomenal storage people that had been in it for 2 years and were self-proclaimed, they just knew everything. They were so good, right? And I'm like, when you buy with that attitude that you know what the future is going to have, when you know what's going to do, you're going to get hurt. And so that's why I always put in, once again, I saw this through from 2008. I saw the people that went bankrupt. We bought businesses. We're performing back then. I had to have my margin of stupidity. That's how you go into 2025. Buy good deals, allow those deals to not be perfect, right? In today's environment, don't expect the market to bail you out, but only buy where the market is going to not hurt you. It's going to, improve. It has all those fundamentals, but don't expect it. If you do those things, your success will be wildly improved. And not success rate, but actually the level of it. All those things for 2025 I see, and we are buying, building, developing in a way that we have not in 2024 and did not in 2023.
We're primed and ready to go, man. We're, like you said, we're working on getting more liquid, being able to just go out and execute, redeploy capital.
That was one of the biggest things that saved us. We went huge liquidity position when I wrote the thing in 2021. When everything was good, everybody was spending money. We took out millions and we put them in the coffers because there was no more margin of stupidity in the market. And I'm like, if anything goes wrong, we're screwed, right? And so, right, it wasn't that we knew necessarily it was going down. We knew it could. We understood that at the deals you're looking at. So I often say I don't predict markets, but my money does. If a good deal is a good deal, right, then it will survive and do good. But the money gets a low return and it's not a good deal, it's going to die in a bad market. So you can actually see as those things get thinner and thinner and thinner and squished, as your margins, as prices just go up, as the returns just drop, the market is ending and your money doesn't want to buy it because it can't get returns, it can't do anything. That's when you know the cycle's ending. We're at the opposite end. We're getting 9 caps with upside, right? Your money wants to be deployed, but our brains and our emotions, because we've seen past or we see the news, it's stopping us. Listen to your money. And build in a margin of stupidity, and you're going to kill it in 2025 to 2030.
AJ, I love it. I think it's a fantastic place to wrap this one.
Right on. All right, everybody, get out there and do it. Talk to you next week.
Thanks, everybody.